In this module, we're going to discuss how we calculate returns, or how we measure those returns and how we calculate those returns. In finance, that's a bit different than maybe we would look at it from an accounting standpoint, but essentially what we're doing when we're measuring returns for financial measures or financial use is to look at cash flows and discounted cash flows. As I stated on the previous slide, finance is concerned about cash flows and the discounted cash value of cash flows. So everything in finance revolves around those cash flows, when they got them, and again, the present value. Second point here on this slide is that we in finance, or when we're looking and doing financial analysis, we do not explicitly use accounting returns. We don't use net income measures that are calculated for corporations. We don't use the return on assets, return on investments that are calculated by the accounting profession because those aren't explicitly related to cash flows. Those accounting reports, while we don't use them, are useful as they may provide a signal for future returns. One of the things that you'll notice if we have an announcement of earnings announcement of a corporation, that may change its stock value. Sometimes it will, sometimes it won't, but most of the time those stock value changes are because the accounting earnings are different than what was expected, and that may signal something, either better returns in the future or lower returns in the future. So while those accounting reports aren't specifically used in calculating and looking at financial returns, they are useful as a signal for future returns. Another point, and this is a big one, is that we are concerned about future cash flows, those cash flows that are going to occur in the future and the attendant risks around those cash flows. We really do not care what previous returns were. We don't care what the cash flows were in previous periods from a stock, but what we do care about is future returns. And while we're going to spend a lot of time in this module talking about and calculating historical returns, it's very important to remember that the historical returns really are only serving as a guide for estimating the future returns. Again, what we're concerned about the future returns. The companies, if we're looking at a corporation, previous history may provide a very good indication of what they will do in the future. Therefore, we look at the past returns only to get a gauge of what future returns will look like. I'm going to introduce this notation now as we calculate returns from the period, for a period. And you have this notation here listed on this slide as well as on the notes. T was a time period. For our case, we're going to say it's a year, but it could be a day, month, or week. And in fact, in the next module, we'll be calculating daily returns for Microsoft. So that time period could be a year, or a day, or a month, or a week, for that matter. It's important that it's consistent or the same throughout the analysis. V sub t, second line there, big V sub t is the value at the firm at the end of period t. This for a stock is given by its stock price. So a stock price, Microsoft, the value of that firm is given by the value of its stock. We have one value measure, V sub O, which has a special meaning. It's the value of the stock price right now. So V sub O, if you're looking at this right now, would be the returns that are being quoted on the stock market as of this point in time. D sub t here is the dividend of the stock, and small d is the discount rate. And we're going to use this notation throughout. I describe this the notation in terms of a stock, but you could do just as well as with a bond. For example, bond, V sub t would be the value of the bond. D sub t wouldn't be the dividend, but would be the cash flow or the interest or the payments from that bond. Again, this slide deals specifically with V sub whole or the stock price. And it's important to realize what a stock price, at least from a financial perspective, really is. It's the value of the discounted future cash flows from that firm. So here you see it listed. V sub O, or the value of the stock, is the sum of the future cash flows discounted to the current time period. The market is always changing in its assessment of the value of discounted cash flows, or the market price. So and we're making the assumption here that the market price represents the value of the discounted cash flows. So as you're looking at the stock price, and it changes from minute, day, and it goes up, for example. Let's say the stock price was $100, now it's $110. What that signals is that the stock price went from 100 to 110, $10 increase. The value of the discounted cash flows went up $10. Conversely, if it goes from 100 to 90, that means is that for whatever reason, the value of future cash flows have gone down by $10. So what we're going to do is see V sub O change day to day, and it will go up or down. But in this class, we're asking what the current stock price, what will cause it to go up. And again, here you can get some intuition behind that by looking at the equation on the previous slide. And two things will cause the price to go up. First, returns expectations go up. We expect higher returns from the stock. So we have a better income outlook. That will cause the stock price to go up. The other alternative is number 2 there, and that is risk goes down. So for whatever reason, the stock becomes less risky. Something in the environment causes returns expectations to not change, but the value of the risk, or the risk that's out there, to go down. Both of those things would cause the value of V sub O to go up, or the stock price to go up. Here's a graph of the Facebook stock price, and again we're beginning at 518 going to 818. You saw this graph in the previous module, or module 1, and what we're showing here again is the stock price, and as you can see, it's varied over time. It was started out roughly at $40 and then got close to $20. And at the point, and that's where this that circle is, we reached that $20 price. And at that point in time, what individuals were saying is now the discounted value of the future cash flows from Facebook were much lower than initially estimated. A lot of that revolved around being able to develop revenue from the Facebook company itself, and whether or not advertising was the discussion point of whether that would allow Facebook earnings to grow in the future. So that uncertainty, or the belief that it didn't happen, was what caused Facebook stock price to go down. As you can see then, it bobbed around there, but in recent months it has increased, and a lot of the reason why it has increased is because of less concern about advertising revenue, or there's much more assurance of the revenue stream in the future. I want to give another example of a stock price change, and here is a more specific case. Last week on August 24th, 2013, Steve Ballmer, the CEO of Microsoft, announced that he was going to step down and they were going to begin searching for his replacement. Steve Ballmer has been the CEO, Chief Executive Officer of Microsoft for a long time, and has been with Microsoft from the beginning. So this is one of the key people that has been involved in Microsoft. When he announced his stepping down, and you can see the sub headline there showing, indicated by the hand that showed up, that Steve Ballmer to leave within a year, stock price jumps 7%. What that stock price jump meant is that the market, or collectively the people within the market, thought that Steve Ballmer leaving was good for future cash flows, and stock price jumped 7%, which is a pretty significant jump for a one-day change in the stock. That, if you're Steve Ballmer, isn't a vote of confidence. In fact, it's a good kick in the teeth here. Thanks for leading this company. But just some of the market indications of Steve Ballmer's worth, or the change in the worth to the company. In fairness, I'm not sure that was warranted. Microsoft has been a very profitable company. It generates obscene, in fact, profit margins from its business, or not obscene, but very large profit margins from its business. What everybody gets concerned about is that it's two major products. Microsoft Office, which most of you are going to be using Excel as part of that Office, and Microsoft Windows has a limited life to its technology, that someday Office and Windows won't be as dominant and will be eaten into by other modes of computing. So there is that concern that those two main products that generate a lot of the revenue won't exist forever, and that Microsoft is slow to innovate. An interesting fact is that Microsoft did invent a tablet similar to the iPad, but chose not to market that iPad. And again, some people would look at that and say, hey, they had the technology, they were developing it, and chose not to go forward. It's a sign of their risk averseness, and that is one reason why we don't expect the cash flows to remain as good for this company into the future. Whether or not that is the case will remain to be seen. Microsoft has had a good run, and people are making their judgments, and some people think those judgments are optimistic. Some people think those projections are pessimistic, and the market comes together on that market price. Now to the nitty-gritty of calculating returns here. And this equation gives the returns V sub 1 minus V sub O plus D sub O divided by V sub O. Let's go through some of the intuitions of that. And that's a rate of return. This will be a percentage. R sub O will be a percent. Let's go through some of the intuitions. V sub 1 minus V sub O is price at the end of the period minus the price at the beginning of the period. This is the capital gain. This is the change in the market value of the stock. So this is the market's estimate of the change in all the discounted cash flows in the future. Capital gain. Second term up there is D sub O, and that's the dividend payment or the current return or the cash return. Those two are added together and divided by V sub O, or the stock price. That stock price represents what it would have taken to make an investment. Sometimes in these calculations you see that V sub O replaced it by stock price at the beginning of the period plus the one at the beginning and ending stock prices, and dividing by 2, or calculating the average. I personally prefer to do the stock price at the beginning of the period, and because that's sort of the rate of return that you would get given that you've made an investment in that asset. But here's the equation for calculating the return or the total return from an asset. Here's another way of looking at that, and this takes that equation and puts it into words. There's two types of returns from an asset. The current return or the cash return. That would be interest, dividends, rent. The second type of return is the capital gain, and that's the change in the market value from one period to the next. The total return equals the current return plus the capital gain, and this is applicable to all assets. It's real estate, stocks, and bonds. Final point here is remember that V sub O equals the present value of future returns, and that does make an important assumption here, and that is that price equals value, that the market results in price equaling the value or the discounted value from that asset. We're going to nail this capital gains through all here. We're going to talk it about again, and I'm very big on the interpretation of capital gains and what it means, and so don't be surprised on the test if we have a question about capital gains and what it means, and you better get it right. All right, here in equilibrium, remember that if we have an equilibrium or a market equilibrium, price will equal value. So the value of the stock is its discounted cash flows. And we have good reason to believe that most of these financial assets are in equilibrium. You can argue that, but in general you'd find that they are in equilibrium. V sub 1 is the price at the end of the period, and it's a discounted present value at that time. V sub O is the beginning of the period, so the capital gain is the change in present value of expectations of future returns during that period. Now we're going to go through some of the mechanics of calculating capital and current returns using historical data. Here we give an example from land, and here land has its current return as cash rent. Here you see 2 years, 100 and 105, and the price, $3,000 and $3,200. Perhaps when you see a outline of returns and prices, the most confusing, and people will do this differently, is where the rent and the price falls. In my example here, I am saying the price is as of the beginning of the year. So the $3,000 price refers to the beginning of 2006. The price $3,200, final price in that series there, refers to the price at the beginning of 2007. So the $3,200 and $3,000 bracket the year 2000, and the $100 return occurs in 2006. So this example, we're calculating the returns for 2006. Current return is $100. Capital gain is $200. And total return is $300. You can see the calculations there and where they come from. We can state those in percents. 100 divided by 3,000, or the price at the beginning of the period, capital gain, and then total return. Here we have a 10% total return. Often financial assets, the major portion of the return is capital gain. Many companies, in fact, don't pay dividends. They believe that they can make a better investment, if you will, or return on their investment than the individual stockholders, so they keep those returns. So often, the majority of the returns is capital gains. Here's another example from our XYS stock example, and you can see the dividend and the prices. And one of the homeworks is to calculate the current capital gain and total return for this example stock. Here is another example, bond return. Here the current return is the interest repayment or the current cash flow, and you see the prices there. Calculate the total return, current return, and capital gain for 2012. Note in this case that the capital gain may be negative, so total return may in fact be negative as well. Capital gains can be negative, obviously, because during periods of price declines we'll have negative capital gains. This concludes this module. The next module will give examples of calculating current returns for time series.